Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 23 years in the game, so you skip the mistakes we made and go straight to property investment success. And Jeremy, today, how much do you need for property investing?
I should be asking you. You're the expert on this.
I don't know about that, but we have a special guest that will be dialing in a little bit later that I'm excited for. So let's jump into it. So
tell us, what are the initial investment costs? How do I get into property investing?
Well, there's a lot of variables, I guess. You hear, I think what 20% you'd say is maybe like that rule of thumb you hear a lot of the time. You hear 5% thrown around, you hear 10% thrown around. So there's a lot of variables, but we'll be breaking that down. So we're going to have some visual aids also. So if you do want to see some spreadsheets and numbers, you obviously watch this in video format on the podcast. So let's start with, I guess, $400,000 example for a property.
Nice number.
400,000. So let's say we need around 20% deposit for that, which is around what's that? About
80,000.
80,000. But then there's another component that we need, which is purchase expenses to purchase the property. So typically, stamp duty, legals, could be buyer's agents' fees, building and pest inspections, and potentially a little bit for renovations.
Yeah, that stamp duty is the big one, isn't it?
It is the big one. So we can actually, with stamp duty, I guess it's different from state to state. So in the podcast description, I'll leave a link there. It's a calculator. You can go there, plug in the state that you're in, and it calculates the stamp duty based on the purchase price of the property.
So stamp duty is a state-based tax that's dependent on where the property is, not where you are, but where the property is that you're buying.
And I guess another thing that we're going to discuss is, I guess, lender's mortgage insurance. So what is lender's mortgage insurance?
Right. So when you're a lender, you're lending some money to someone, you've got a certain risk if they fail to service that mortgage, fail to pay interest. So in tight sort of lending conditions where you've given a very large loan as a lender, as a bank, to the borrower, you've got a risk. Now, generally, banks consider a 20% deposit as their sort of their own pre-built insurance. So let's say it's a $400,000 property. You've got a $80,000 20% deposit. So the lender would lend you $320,000. So if something goes wrong and the borrower can't afford to make interest payments, the lender can force the sale of that property, and they're more than likely going to get their $320,000 back. If, on the other hand, it's not a 20% deposit, say a 10% deposit, they've borrowed $360,000, it's more likely that if the property is sold, the bank doesn't get all their money back. So they've got a risk, and they pass that risk on to the insurer, and the insurer asks for a premium to be paid to cover their risk. And so it's the lender insuring their mortgage against that sort of risk. And that's what the lender's mortgage insurance is. The lender passes on that expense, that premium, to the borrower.
We'll move to the screen shortly because I have built a little bit of a spreadsheet just to look at the numbers. But from my experience, it's a great way to sort of, buy a property at a higher price point with less cash. So you can sort of leverage more and you can have that higher return on investment when you're looking at your numbers. When you're analysing a property, because you're injecting less cash in, you're borrowing more. So from an ROI, cash on cash return, you're sort of in a better spot.
Yeah, every time when I've done these sort of calculations to figure out the return on investment for any property that I've bought, one of the most sensitive figures, one of the most sensitive cells is that loan to value ratio. And improving that, increasing that, has often come down to lender's mortgage insurance.
So let's have a look at the example. So on the screen, what we've got is we use that example of 400,000, okay? And this is where we mentioned that 20% deposit. So you need about 80,000 plus 24 for purchase costs to buy a property for 400,000. That's without lender's mortgage insurance. So you pretty much call it 100,000 you need to come up with.
Yeah, so you've put in roughly 6% there. That's not a fixed figure. That's an estimate, isn't it?
Correct. Yeah. Again, it's more most probably for, I'd say, Victoria, because the stamps are higher there. New South Wales lower, Queensland's lower again. But it's just a factor of those things. And potentially if you are using maybe like a buyer's agent or you're doing a small reno, so you buy a property on a big block that's a little bit older, you spend maybe, let's say, 5, 10, 15,000 tidying up the property. So you might have less issues in the future. You don't want to wait for a problem to happen and then...
Yeah. So there'll be a couple of things. It's not a full reno. It's just tidying it up in readiness for the first tenant. Okay.
Exactly, because you want it to be presentable for the tenant also. And you can always talk to, I guess, a property manager about that, like what should be done to a property. Okay. Now, if we look at example 1, you'll notice here that the deposit's a lot lower. So instead of coming up with that 80,000, now we're coming up with 48,000, which is at 12% deposit. Again, the purchase cost is the same in every example, the 6%, but the deposit is going to be lower if we look at the 3 examples. So the first one, with a 12% deposit, we only need to come up with 70,000 now, 72. So instead of trying to save that 104,000, we can buy that $400,000 property with 72. So if I'm only saving, let's say $1,000 a month, that's pretty much an extra, 2 to 3 years extra of me trying to save to come up with that initial deposit for a property. And the thing that you need to think about, what if that property, 400K property, is growing at, let's say, 5% per annum? It's really moving, isn't it?
Yeah, so you're chasing it all the time.
You're chasing it all the time. So in a growing market, a booming market, you want to try and get in sooner rather than later.
So, all right. So lender's mortgage insurance can help you fast track that process.
And there is a fee associated with that. So you'll notice on that first example, there's a fee that and this is just an estimate, but there is a calculator that I will leave in the description. So you can just pretty much go into here and go 400,000 in our lender's mortgage insurance calculator. And how much was it? Roughly, the loan's going to be 352. So the property value is 400,000. The loan is 352. And then it pops up with that LMI or lender's mortgage insurance estimate.
Nice.
Okay. And then I've just pretty much put that in the spreadsheet. That's over here. And if we look at the next example, with a 10% deposit, it starts increasing. So borrowing that extra $8,000 more with that 10% deposit. So now we're going to borrow 360 instead of the 352. The premium jumps up from 4,500 up to 7,000. So a pretty big uplift.
Yeah, it's not quite double, but how much are you saving in savings? So your deposits come down. Well, your total entry costs are now 64,000.
64,000. So it just means, again, instead of trying to come up with 72,000, I only need 64, but I'm paying a premium for that. And then the last example, if we use a 5% deposit, so we're buying a $400,000 investment with only 44,000, but look at the LMI premium, 17 grand.
Yeah, that's a big jump. And that's reflecting the increased risk for the lender.
Exactly. So it's really important. Obviously, you want to buy a really good quality investment, because what you don't want to do is go buy a poor quality investment and then that $400,000, let's use a 1-bedroom unit as an example in a high-rise, and that comes back to 350. So your LVR is going to jump up above 100%.
Yeah, that's the negative equity situation. Yeah.
Negative equity. So one thing also, you can talk to your tax accountant. So if you've ever paid lender's mortgage insurance, talk to your tax accountant, because it's tax deductible over a 5-year period. Okay, so you can pretty much utilize that to bring down your income tax every year. So for example, you've got that 4.5, you divide that by 5, and potentially, $915 you can deduct off your return every year.
Right, that's not $915 you get back. It's just $915 less tax you pay, that sort of thing. Okay,
yeah, it just brings you taxable income. So if you're earning $100,000 a year, your on your tax return, it'll be what, $99,085, and that's what you pay your tax on.
So the tax saving there is probably closer to, well, just a little less than half that. So maybe $400, something
Yeah,
like
well,
that.
an easy way to do it is you just go 900 and then you just times that by, let's just say, we'll say 0.37 as an example, about $340 back in your pocket. But remember, this is only for investment purposes, not if it's your owner-occupier or a property that you're living in. So again, a lot of people aren't aware of it. I've sat down with clients where they've paid LMI and I've said, oh, are you deducting it? Have you spoken to your accountant? Oh, no, I haven't been doing it for years. So again, talk to your accountant about that. It's just a bit of slippage there. But Jeremy, have you ever used lender's mortgage insurance?
Sure did, especially early on. Nowadays, I sort of put in a 20% deposit. In fact, yeah, I've been contemplating paying cash for the next one. But yes, definitely, because those returns on investment always increase if you can have a higher loan-to-value ratio, and the tool to get that is paying LMI.
Well, I just like the idea that you don't have to inject so much cash. So instead of me trying to come up with, 104 or 5,000 for a 400K property, I can come up with 70,000. But that 88% I find is that sweet spot.
Right, so you're not paying a huge premium in LMI, but you're still getting into the market with less of your own funds.
And normally what they do is they bolt that LMI onto the actual loan also, but I can confirm that with our special guest anyway. So it's not like coming out of my pocket, it's getting added onto the loan.
Just thought of another question for our special guest. When are we bringing in our special guest? Are we up to that yet?
Shortly.
Oh, okay.
Actually, yeah, we'll bring our special guest in. So we've got, we'll bring up on the big screen. So welcome, Alana. Can you see us okay? I'm dialing the friend. Here we go.
Sure can. Hi, legends.
Hello. So Alana is from We Mortgage Solutions in Melbourne. So we're based in Sydney, but we've obviously got a great relationship. We've known each other for how long? 6 years?
Yeah, I reckon about 6 years now.
Hopefully, did I get a lot of that right with what I was explaining before? Because you're the mortgage expert.
Yeah, no, it all sounded fantastic. I probably think the other thing to mention around lenders' mortgage insurance is the reason also that 88% borrowing is a sweet spot is once you capitalise the LMI onto the loan amount, then you start to go over 90% LVR, and then your interest rate will be a lot higher too. So keeping the loan at 88% plus LMI definitely works in everyone's favour.
That was the question that I had. Are the interest rates the same for each premium of LMI? But you're saying no, it actually increases for certain LVRs.
That's right. So 88% plus LMI, generally you'll be just a tick under 90% loan to value ratio. And then once you start going higher, then you start to get into the 90 to 95% band. And then that's where interest rates really go up, especially if you're doing interest only for investment, then that's a lot higher than principal and interest for owner-occupied home too.
So, Alana, do you know why the interest rate is higher for a higher LVR?
I guess it's because you're getting the benefit of accessing more money, putting in less cash, and you're seen as a little bit more riskier to the lender.
Yeah, so this is something that's bothered me in the past, particularly in the early days when I was so dependent on LMI. The bank is considering you a higher risk, so they increase the interest rate because I guess from their perspective they're thinking, well, we're taking a higher risk, we want a higher return. But by increasing the interest rate, they've now got an even higher risk because it's now harder to service that much interest. So then they should charge an even higher interest rate, but then it gets even worse. So it just seems like a peculiar response that the banks take with this. But anyway, that's their policy.
Yeah, they like to, especially smaller lenders, they like to limit the type of clients they have in certain bands. So they like to have an under 60% LVR, then they'll have a certain number of under 70, under 80, under 90, and it's just a way of limiting the amount of clients they have in each band and minimising their risk.
Right. Yeah, excellent.
All right. Well, now I'm going to do a bit of screen sharing, Alana, and obviously looking at your expertise. But we've worked on about maybe 6 years or so. We've worked on clients together. Obviously, I've seen a lot of clients come through in initial consult, so I've got a very good understanding. Now, I'm not a mortgage broker, but I've worked with, I'd say, potentially hundreds of brokers. I've seen the good, the bad.
Yeah.
Majority are good. I think I've had maybe 2 really bad experiences, but I'll be throwing some questions your way. But yeah, I'm really looking forward to it.
Sounds good.
All righty. So let me, I'm just going to share the screen. Okay. So now don't judge me with my my drawing skills. I was never very good at this. So
you're going to take us through now how people can get into the property market? Like what are the sort of common strategies?
yeah, potentially. That's what we're going to be looking at now. So we're going to look at some potential strategies. But I think the main one, if you already own a property, I just really want to I want to bring this up. So for example, let's say we've got an existing property. So I want to discuss what an equity release in, and just jump in anytime that you like, Alana. But back in
Perfect.
when I was in Melbourne, I had the whiteboard back in the day pre-COVID, seeing a lot of clients face to face. So I used to get this up on the whiteboard, but let's just say we've got a client that has $1 million property, just as an example to round it up. And let's say there's a $500,000 loan attached to that. Now, Jeremy, trick question. What's the loan to value ratio on that?
Oh, I know this one. 50%.
50%. Now, we'll bring another example over here. We're going to be buying a property. We'll say, let's just call it investment property 1. And we'll say 500,000, roughly 500,000. Now, this is where I've seen it all. I've had clients that have had money in an offset and they've used personal cash to buy an investment property. But what we want to do here is obviously look at maximizing the amount of investment debt that we have. And I think a lot of people struggle with this concept. But the whole idea with, I guess, a good broker is you would release equity. Is that correct, Alana?
Exactly right. Saves you taking on lender's mortgage insurance on the new property.
So in this example, let's just say we're going to take out, we'll call it what, 130,000 maybe, roughly?
Yeah.
130,000, which is a small component of this loan. It's only 13% over here. But I guess for this property, 130,000.
Right, so that 130,000 is your deposit and other purchase costs to get into to purchase that 500K property.
We'll call it the 26%. So we'll call it for the 20% deposit, and that 30,000 extra is for all the purchase expenses that we mentioned earlier: stamp duty, legals, building and pest, whatever it might be. That's what that's used for. But normally, Alana, the equity release, you've got money sitting in an offset account, don't you? Typically, before you buy the property. So
you'd release that 130,000 of equity prior to your search for the new $500,000 property, and have it ready to go, and make sure you go to a lender that lets you control those funds. So you don't need to have these properties linked at all.
So you've got like the 130,000 there, and you've got pretty much 130,000 that sits in a offset facility.
That's right. So it'd be interest only if this new $500,000 property is investment purpose. So you wouldn't pay any interest till you start using those funds towards the new property.
Correct. So then what happens is, and we'll have a future episode on principal and interest only, investment debt, personal debt. But just to try and make it hopefully as simple as possible for the listeners is, we buy this property for 500,000, we settle on it. This loan's going to be 400,000. Okay, and that's 80%. So we've borrowed over here now. We've got 106% worth of investment debt. We're really maximizing our investment lending for investment purposes. So we get, I guess, we can claim a lot of that interest over here. Again, talk to a tax accountant. This isn't advice, but always clarify that. All right.
Okay, so that's the equity release. So there's saving. You just save up cash and buy. And this is another way in which you can do it, which is an equity release from your principal place of residence, where you're living.
Well, yeah, what I've seen in the past is they might pay off like a lot of their home, or what they do is they put a lot of money, they got it in the offset. Let's say they've got 130,000 built up in cash. They take that money out of their personal property and use that as a deposit. So what they're doing is they don't have that extra investment debt. So it's like, let's say this loan's paid down to, let's say, 320, and they take out 130,000, which is their personal cash to fund that purchase, that wouldn't be deemed as deductible to my understanding. So this keeps it really clean. This is like, you don't want to mix loans, you don't want to join loans together, otherwise it gets real messy.
Alana, I assume this scenario, this equity release, is the most common case that you see for purchasing an investment property. Do you get many cases where it's a rent vestor and the only property they own is this investment property?
Yeah, you can do exactly the same thing for investment properties as well. You can even have some scenarios where when the client initially took on lender's mortgage insurance, you can go back up to that LMI amount. So say they borrowed at 88%, you can re-borrow up to 88% at the new value and just pay a small top-up premium. So your lender's mortgage insurance premium isn't going to be as high as the first one. It might be a couple of K of a top-up. So that's a handy thing to know as well. But it means you're staying at the same lender, because then you lose that benefit.
Right. So in this case where we've got $1 million home, the owner of that home may have purchased it for like 750,000, and now it's grown up to $1 million. So they've got more equity. Now they can borrow against that. That's what you're talking about, that incremental increase.
Yeah, that's right.
Yeah.
All right, good. Any more questions on that, Jez?
Okay, so we've got, you can save up cash, you can release equity. How else can you get into the property market?
The other one is, I think, in my experience, I've had clients where we went the parental guarantor route. So I'll let Alana touch a bit on that. So what's a parental guarantor, Alana?
Yep. So basically, the borrower has to be able to service all of the lending. So it's not the parents, using their wages to help with servicing. It's parents putting up their home or an investment property. And then you're really doing that sort of 26% loan that we saw in the last example. That's linked to the parent's home or investment property. And then you're borrowing 80% against the next purchase you're making. But the parents are just guarantors. They're not helping with servicing at all. There's a few different complexities. If the parents already have a loan on their home or investment property, then that might dictate which lender you can take that to. Generally, that 26% loan would have to be principal and interest repayments, even if it is an investment property. So for clients who are doing cash flows, you'd want to factor that in, because the banks want to see that you're trying to repay that loan that's against the parent's home first, prior to paying off any other lending. It is a full valuation of the parent's home as well. So you probably wouldn't do it if your parents are doing a huge renovation on their house. It needs to be in good condition. The broker needs to interview the parents as well. So there's just a few extra boxes to tick, but it's a really great way to get into the market. And then as soon as that property, this $500,000 property that you bought, goes up enough, then you'd refinance probably to a lender that gives you the highest valuation. And then that's how the guarantee is released from the parent's home.
So if we look at that example what you had before, so let's say this is the home on the left, so it's worth $1 million. Their loan is $500,000. Now, I know clients would freak out because it's like, or the parents would, because they don't understand what a parental guarantor is, or they've watched Current Affair or something and they just freak out. So I think it's really important to sit down with someone, because it allows, I guess, yourself to get into the market a lot sooner. Because I think when clients are building portfolios, they're like, oh, I want this to be passed down to my kids one day and this and that. And it's like, well, to teach them good habits, maybe it's good to try and utilize a parental guarantor so they can get into the market a lot sooner. They've got that responsibility, but they both need to be in really good cash flow positions. One, are they saving? Like if they're just spending everything, it's not a great sign. So you want to make sure the buffers are in place. But with the whiteboard that I've got on the screen, they would release that 130 for this property to fund that deposit. So again, the kids would be, or whoever it is, the child would have to pay for the loans, the 130 and the 400. The kids.
Exactly. Their wage would need to show they've got the borrowing capacity to service those. So it's really just using the parent's home or investment property to get the equity from.
Right.
I think it's
Deposit.
quite. To me, it's quite rare. Like I've had maybe I'd say maybe half a dozen clients have utilised it. The one I can specifically remember is they were working towards about young couple in Melbourne, and they had around $100,000. They were working towards $100,000 deposit. But what they did was they used the parental guarantor first to buy around that sort of 450, 500. They bought the property and then they went again maybe like 3 months after paying lenders mortgage insurance at 88%. So first they used the parents' property as collateral, so they're able to get in. So they didn't have to inject any cash whatsoever. And I did cash flow modelling for them to make sure that they're hitting their targets. And then they used that 100,000 roughly to go buy an investment property right after. So they bought 2 properties within 3 to 6 months. So really trying to get into the market a lot sooner.
Yeah. So the idea of that strategy then is you're utilising someone else's equity when you can provide the serviceability, the ability to pay interest on the loan.
That's the key thing. You need to be able to borrow the money too. If you're taking on this lending, you need to be able to get that cash, correct, or those funds.
Exactly. And in the scenarios I've had with people doing parental guarantors, most of them are being able to release within 2 years. They've obviously picked the right property and used a buyer's agent potentially. And yeah, we've been able to release that and refinance elsewhere and remove the parents from the loan.
Yeah, that's a good point too, because you want that to happen as quickly as possible. So you need to enter into a market which is going to have some good capital growth straight away. And then you've got that built-in equity straight away and you can refinance. And Alana, it's called parental guarantor, but do they have to be related?
Yes, generally they have to be related. And then it will also be a challenge if the parents are fully retired. So there might only be 1 or 2 lenders I can take that sort of scenario to, because they want to see that the parents are still in good financial stead for the future if something was to happen.
All right. Well, another examples could be like I've seen clients where they've come in and they've already purchased with siblings or family members. Now, one thing I see all the time, they don't have a game plan. They just buy a property because they needed to try and get in somehow. But then it's like, okay, what's the game plan? So what challenges can you face as siblings? Well, I guess siblings buying a property. To me, my understanding is it can really hurt borrowing capacity. So if I buy a property, for example, like with my sister, the lenders would only take 50% of the rent for servicing, but they take on 100% of that actual debt for servicing. Is that correct?
Yeah, great point. So it depends how you set it up at the start. So there's 2 particular lenders that do more of a property share agreement, and that means that your banking is totally separate. So one person might only be able to afford 30% of the property with the borrowing and the deposit they have to put towards it, and the other person might have the 70% ownership. And then it means that your loan is 70% of the property, the other person's is 30%. And you can only see your online banking and your loan amount for your portion, and the other person is a guarantor for that, but it doesn't come into their future plans. So if they partner up and want to buy a home in the near future, if their portion's only 30%, well, that's their lending amount that will come into the borrowing capacity calculator.
It's good to know.
Yeah, good stuff.
But there are lenders, I think there was like one a while ago where they did potentially take into account like all the rent, but it's very rare. You're limited to lenders, aren't you, and servicing?
Yeah, I think you're better off potentially doing the property share loan arrangement, and then you're getting like your 30% of the rent plus you're getting your 30% of the mortgage. I think that works out a bit better for future planning.
Okay.
So if you had a large number of siblings, it's less likely you can use this approach, isn't it?
Yeah, that's right. I think it's up to 4 people potentially for property share.
Right.
Ideally, in my time, make things simple. Talk to your accountant, make sure you got the structure right, make sure you know where you're heading, and talk to a really good broker, because I think a lot of brokers just look at serviceability in my time, and then I've looked at their finances and gone, okay, maybe you can reduce your credit card, you can remove your HEX debt, maybe you can roll your HEX debt up into your mortgage. Like, where can you free up capacity in certain things? I think that's really important for a good mortgage broker to ask those questions, not just look at the finances and go, oh, this is what you can borrow. What levers have we got to play with? I think is crucial. So the other thing is maybe gift from. Do you want to say something, Jeremy?
No, I was just going to summarise where we're at now. So there's savings.
There's
equity releases. Use of LMI. There's equity release. There's the parental guarantor.
Siblings, potentially.
Siblings.
I'd say gift from a family, but again, it's quite rare. But there are instances where I know clients would come in and they maybe get inheritance or a gift is most probably another way. So it's got to be a letter, doesn't it, if it's a gift?
Yeah, so some lenders are okay with a statement. Other lenders will want it on a statutory declaration. And generally, unless you've got boatloads of capacity, if it's a gift that's not repayable, that won't impact servicing. But if on the letter it says that you need to repay this gift, then that needs to be factored in, and that's like a loan or a debt that you already have.
Okay. The other one is, I would say, private lending. So this is quite rare. In my time, I haven't seen anyone really utilize it, but there are companies out there where, let's say you're fully limited, no banks, second-tier lenders will look at you. You can go to private companies, but they can take up multiple things, I think, as security and collateral, but the interest rates are through the roof. And I think it's more for like developers or short-term type of projects. But have you had a lot of experience with any private lending or not really?
I've been lucky. None of my clients have needed to go down that avenue. It's probably pretty risky, but I believe interest rates, can be anywhere from 10 to maybe even 20, mid 20%. I guess unless you had a definite exit strategy, it was a short-term band-aid, then yeah, I'm not sure I would consider it personally, but
okay.
There must be appetite for it.
Risk, yes. So
there's another one actually, and I've used it, vendor finance. So the vendor lends me the deposit. I had to come up with like stamp duty and other purchase costs. And then they have a second mortgage over the property. And then, of course, the primary lender who gives me the 80%, that's the first mortgagee. Yeah. Anyway, that's another one.
But back in your day, when you accumulated, you were really aggressive, though. And it's a lot harder to get the type of lending now compared to, 10, 15 years ago?
And that was a very bad deal in the end for me.
Actually, how'd you get lending in New Zealand when you bought in New Zealand?
Oh, a New Zealand lender, a bank. Yeah.
Okay.
Yeah.
I've had a couple of New Zealand clients in the past, but where they released equity here and then they bought overseas. And yeah, it's interesting looking at different scenarios. But let's jump into, I know there's like a first home guarantee from Housing Australia. So you can purchase with a 5% deposit and move in, but you need to live in the property. So it's a 95% loan from the government. Is that correct, Alana?
The loan is through whichever lenders have, the spots left for that particular year. And then Housing Australia or the government guarantees the difference. So because you're not taking on lender's mortgage insurance, if you were to default, then the government has to sort that out with the lender.
Okay.
Yeah.
All right. No, that's good to know. So, I think I've actually put it up on the screen and I'll leave the link also, but it's limited, isn't it? So 35,000 applicants a year, 125K for a single person or 200K for joint.
Yeah.
And then it's price capped. And then in Sydney, I think, is it up to, let's have a look. It is first home buyers scheme. I've got the Super Saver up on the screen. Apologies for that. I've lost my train of thought there. It's so up to 900,000 in Sydney, and I think 800,000 roughly in Queensland.
Other states, yeah, in most other states in metro areas, and then regional might be a different price cap, generally a touch lower.
Okay, yeah, here it is up on the screen here. So it can vary depending, but if you sort of go down, we've got it. So 900,000, 800, it's like 800 in Vic, and then 700. So it's capped in certain areas.
Yeah, each state has a cap.
Are you seeing it often now? Like where clients are taking advantage of the first home?
It's a great scheme, but the issue is still borrowing capacity. So even if you look at the single parent scheme where you can actually borrow 98%, you only need 2% down. To be able to get into that scheme, the income's 125K. Your borrowing in that scenario might only be 420,000 at max capacity. So you're still not buying for the price cap. that
That's
might be
right.
600. Yeah.
And I guess it's the quality of the property that you're buying too. Like in Sydney, 900,000 doesn't get you much. So it's a good way to maybe get in, but you want to make sure, again, you've got those really good habits in money management. Like, is that something that the banks will look at? Like they'll look at your statements and go, oh, this person can save, or they just don't care. If you've got the deposit and serviceability, it's okay.
No, they do need to see genuine savings accumulated over 3 months of time, but there are some levers you can pull with that. So if someone's been paying rent for all that time, you can help by using the rental ledger and say they've been paying their rent on time every week. That can also help to show genuine savings.
Okay. Yep. The other thing, so that's good to sort of cross that. And then the other thing is I wanted to discuss is a super saver. So again, really rare in my time. I haven't had many clients that have utilised this, but this is where you can make a contribution to your super, and this can be used to fund the deposit of your property. I think the main thing here is, I guess, the tax advantages that you would get by investing or having the money in super. But there's a lot of, I guess, rules around it. It needs to be for a property that you're going to move into. I think it's going to potentially be your first property. But I'll leave the link in the description, and clients can, or anyone listening can go through it themselves. But have you had a lot of experience with this super saver scheme?
Yes, I've had quite a few clients do this. I think it's a great scheme. It's great if your income's recently gone up, so your borrowing capacity is there, but your savings might be a little bit behind. You just have to make sure that you get approval to access the FHSS scheme prior to purchasing, and you get that letter, and then the funds will be released by the government from your super.
Okay, and I think the big disadvantage is you might have that market fluctuation. So if you're saving for a deposit, I might have it in cash in a high interest savings account, 4.5% maybe, and there's no risk really on my money besides obviously inflation. But at least I'm not going to lose my cash. But if I invest it if it goes into super, I think it may be invested. But again, you need to talk to maybe like a financial planner about that, a mortgage broker. But I have seen it with clients in the past. They have brought it up, but very rare.
Yeah, no, I've had a couple of clients, even a client from New Zealand managed to access their super from New Zealand by transferring to Australia and using the Australian scheme.
Okay.
So that's really great.
And I think the last thing from me is obviously like no stamps. So I guess it's different from state to state. In New South Wales, I think it's up to around that sort of 800, and then it gets prorated up to $1 million. And I think 500K in Queensland. If you move into the property and it's your first property, there are no stamp duties. So that's another way we can sort of save on those purchase costs that we mentioned earlier. But anything more to add? We've covered a fair bit.
Yeah, that's been really informative.
Thanks, Alana. So what we'll do is we'll leave I'll leave a link to like your details in our description if anyone wants to talk to you, I guess, from a mortgage perspective or thinking about investing or refinancing. They can talk to you. Like obviously, we've got a great friendship, so there's obviously that trust there. But you're a gun at what you do, and we've seen a lot of scenarios together, haven't we?
Oh yes, we have. We've helped a lot of people. I get a lot of pleasure from helping people get in a better financial position. So I'll be happy to help anyone who wants my help.
And we'll definitely have you in some future episodes, I think. What do you think, Jeremy?
Yeah. Thanks very much, Alana. It's been, I'm amazed at how quickly you answered a lot of those tricky questions. So you've seen it all before.
Oh, good to hear.
Well, you think it's simple.
Many times.
You think it's simple, don't you? Like you go online, okay, you can go in with a 5% or something. There's so many different variables and angles that you can get into. So I'm happy that we've got a platform that we can actually share it with everyone. And if anyone's got questions, they can always leave notes in our description.
Yeah, good stuff.
All right.
Thanks again, Alana.
Take care,
My
Alana.
pleasure. Thanks for having me, guys.
Bye.
Okay, see ya.
Talk to you soon. Bye. Bye.
How's that, Jeremy?
Yeah, really good. Look, I think if anyone feels like they know someone who needs to hear some of this, we've got a share link that you can click on, and that makes it easier. And if this is the sort of content that you find interesting, give us some feedback. Give us a like. Give us some comments. And, of course, if you want to devour more of it, there's a subscribe link as well. Yeah. Have you got any closing thoughts, Damo?
I just think don't give up. Yeah, I said don't give up. You're going to have days where you're up and down, and I think just try and be consistent at saving. It will compound over time. You're not going to get rich overnight. Like I'll never say that, but just take your time, have a long-term view, and I don't think you can go wrong, and build a solid team around you. And in future episodes, we will talk about the team that you do need, because everyone's got their ideas or opinions on it. But
yeah, and another future episode, once you've purchased the property, I wouldn't mind going through some of the costs involved in owning, repairs and maintenance, property management fees, all that sort of thing.
yeah, and I think, like I said, I know we've said it a lot, is just be careful of the type of asset that you're purchasing, because the last thing you want to do is leverage up really high up to, let's say, 90% LVR, which I've seen, and then the property value drops, and then you're in this position where you're backwards right away.
Yeah,
So-
it does happen.
All right, so I think, Jez, as you mentioned, everyone can just subscribe, like, share. Thanks for tuning in, and see you in our next episode. Bye for now, and take care.